The S&P 500 ETF VOO and the NASDAQ 100 ETF QQQ are some of the most popular ETFs with a long history of providing some amazing returns over time. But what if I told you that there's an ETF that takes the top 100 best performing companies from the S&P 500 index? And this ETF manages to crush both QQQ and VOO when it comes to performance over these past few years. In this video, I'll be talking about what this ETF is and all the details about it, along with how it compares to the S&P 500 and QQQ. So let's get started. Since this ETF functions differently than a broad market ETF like VOO or a growth-oriented fund like QQQ, I want to explain how it works. This fund is what you'd call a momentum ETF. A momentum fund is an investment fund that buys companies that show strong trends in earnings or price movement. This approach comes from the idea that stocks that are performing well in the recent past are likely to continue doing so in the near term. And these type of funds typically follow momentum indexes and generally target the past performance of stocks over the last 12 months. They also give momentum scores based on their performance, along with metrics that may require some fundamental analysis and technical indicators. The point is that this combination can allow these ETFs to build a portfolio of companies that not only seem strong in the short term, but also have a good quality and can sustain doing so. Now, since momentum in nature is short term and it can change quickly, these funds need to regularly rebalance their holdings. And this is to be sure that the ETF is going to capture the current top performers in the market. For this reason, the holdings in the fund can change quite a bit when it's time for a rebalance. So now that you have a better understanding of what type of fund this is, let's talk about the ETF. So this ETF is SPMO, the Invesco S&P 500 Momentum ETF. This fund is based on the S&P 500 Momentum Index, and it tracks the performance of the stocks in the S&P 500 index that have a high momentum score. When it comes to how the strategy works, there's a few steps. First is that the momentum value is calculated. To give you an example, this chart shows the 12-month price change for a stock. Since the last month is being excluded, the remaining 11 months are going to be considered. By filtering the last month, it hones in more on the long-term trend, which can remove any recent volatility, such as a short-term sell-off or whatever the case may be. Next, the momentum value is going to be adjusted further by considering the volatility of the stock and whether there's been a positive or negative price change over time. From there, the index adds the top 100 stocks with the highest momentum scores. Each stock, depending on whichever value is lower, will have a weighted cap of 9% of the index, or 3 times its market cap. And the ETF is reconstituted and rebalanced twice a year on the third Fridays of March and September. So there's quite a bit involved in its filtering process, but that's how SPMO strategy works to pick the market winners. Now that you understand the strategy, let's talk about how the holdings and sectors are structured in SPMO currently compared to VOO and QQQ. In line with SPMO's index strategy, this ETF has 100 holdings in total, with its top holdings in names like Nvidia, Meta, Amazon, Broadcom, Walmart, and a few others. These holdings are probably not much of a big surprise. They're all big names and mostly around tech, but with the outsized growth recently, stocks like Nvidia and such are likely to be on here until there starts to be a shift in the market some. For the sectors, SPMO is composed of technology up top at around 24%, financials at 18%, consumer discretionary at 15%, communication at 14%, and the remaining spread in a few other sectors. Unlike other funds that have a high concentration in the tech sector, SPMO targets those high momentum stocks from a variety of sectors. For that reason, you can see from a sector standpoint, it's pretty diversified, and aside from a bit more tilt in the tech sector, there isn't one sector that's overwhelmingly larger than the others. If we take a look at the top 10 holdings compared to the popular and well-performing funds VOO and QQQ, you can see there's some similarities. Some of the Mag 7 like Nvidia, Meta, Amazon, and Tesla. The percentage of the top 10 holdings that make up the portfolio for SPMO and QQQ are over 50%, while VOO is under 40%, making these two a little top-heavy and VOO a bit better balanced here. If we shift over to the sectors between these funds, it's a bit different. QQQ is much more concentrated in tech than the others, with communication and consumer discretionary following up and no exposure to financials, since this fund is structured that way. Surprisingly, SPMO has even lower tech exposure than both funds, while it has more in financials and names like JP Morgan and Goldman, along with consumer discretionary names like Walmart and Costco. Next, let's get into the performance for SPMO and how it compares to the other ETFs. SPMO has been around since October 2015, so just under 10 years. And since its creation, it's had annual returns of over 18%, so it's been doing really well so far. Now let's see how it compares to VOO and QQQ. So over the past year, SPMO provided returns of over 30%, beating out QQQ at 21% and 17.5% from the S&P 500 ETF VOO. If we zoom out to the last 3 years, SPMO is still well ahead with over 100% in returns. And from a 5-year outlook, SPMO has an even larger gap of over 40% compared to VOO and QQQ. Now, this doesn't tell the whole story, as there has been quite a lot that's happened since then, and the run-up really starts not too long after the drop in 2020. Since we had quite a big few names rally during this time, like Nvidia, Broadcom, and Meta, SPMO's strategy allows it to capitalize on these well-performing companies. If we zoom out even more, since SPMO was created in 2015, you can see that QQQ actually outperformed them all, with the SPMO really taking off more so the later half up until now. So while QQQ has had some pretty explosive growth, it does come with a bit more volatility. By this I mean beta, which is the measure of the risk or volatility of an investment compared to the market as a whole. In the S&P 500, it's basically the market standard, so it has a value of 1. Anything above 1 is going to be more volatile and have more risk, and below 1 is going to be less volatile and less risky. The 5-year beta for these ETFs is 1.17 for QQQ, 1 for VOO, and then SPMO a value of 0.97, making SPMO the least volatile out of the 3, which you might not have assumed. To give you another perspective, if we look at the largest drawdowns out of the last 10 years, you can see that SPMO has the lowest at around 21%, VOO with just under 24%, and then QQQ with the largest drop at around 32%. While QQQ does carry more volatility, you can't ignore the fact that it's had some really great returns over time. As for SPMO, it's offered solid returns as well, with lower volatility than the others, and it's shown a bit more resiliency during the drawdowns that it's experienced. And when it comes to cost, SPMO has an expense ratio of 0.13%, costing you $13 for every $10,000 invested. SPMO falls in the middle with a higher fee than VOO at 0.03% and less than QQQ at 0.2%. Let's get into the benefits of SPMO. First is that SPMO has a high potential for growth. Its methodology of momentum investing, along with its selection and weighting criteria, allow it to provide exposure to some profitable stocks and strong momentum. It also offers a good risk-to-reward profile. SPMO's drawdowns weren't nearly as low as VOO and QQQ, and it still managed to offer higher growth than VOO in the overall market and close to the growth of QQQ, given that they track different indexes. Next is that it can offer a nice level of diversification and balance. It's 100 stocks out of the S&P 500, so it can't be more diversified than the index itself, but it isn't limited to specific sectors or industries, since its holdings will reflect what has momentum in the market. When I compared the sectors between these funds earlier, you could see that SPMO had less concentration in tech than the others, and it was a bit spread more evenly overall. This, of course, can fluctuate due to the 2 rebalances it has every year, but it's nice to know that it can hold the top performers across a variety of areas. So, what are the downsides of SPMO? For the cons, the first point is that SPMO could underperform in certain market conditions. The momentum strategy isn't always going to do good, since performance can depend on the stage of the market cycle. For example, momentum strategies do very well during an expansion, which is where we are currently. And if we transition to a slowdown or a contraction or recession, then the momentum is going to struggle. And more defensive factors like quality, lower volatility, and higher yield will sustain better, while more cyclical factors like value and size would be on the bounce back. This leads me to the dependency on recent momentum. This strategy is based on momentum and the recent performance of stocks, rather than a more straightforward and disciplined approach and strategy, which some may view as a type of performance chasing. This next con would be concentration risk. A benefit of SPMO is that it can offer some diversification, but in the case that a few sectors are experiencing strong momentum, This could cause the fund to be heavily concentrated in one or more sectors. And speaking of concentration, SPMO tends to be top heavy. The top 10 holdings of SPMO over time often make up over 50% of the total portfolio, like they do currently, so these top 10 are going to play a big role in movements. So should you add SPMO to your portfolio? SPMO has offered some returns that rival some of the best ETFs over the past few years and at a reasonable cost. And it's benefited from the momentum and growth that a variety of companies have provided during this bull market. I don't believe that you should swap out a foundational ETF like VOO for SPMO, since it's not meant to function or replace an ETF like that. And instead, it could complement a core fund or make up a part of the growth portion of a portfolio. I think it's important to weigh the pros and cons of SPMO to see if it makes sense for you and if it aligns with your investing strategy and goals. If you like what SPMO has to offer and you're okay with the strategy of selecting the top performers out of the S&P 500 index, then this could be a great fund for you. And if you want to see what the best ETFs for growth are, then be sure to check out this video here or watch this video here to see the best ETFs to buy and hold in your Roth IRA for some serious tax-free wealth. If you got some value from this video, be sure to like and subscribe. Keep on investing, and I'll catch you on the next one.